Hello, finance students. This evening I'd like to discuss chapters 10 through 12, covering project analysis, an introduction to risk, return, and the opportunity cost of capital, then talk about the capital asset pricing model, or CAPM. Chapter 10 discusses how we value projects. Thus far we've been choosing between projects based on their net present values. In our Chapter 9 mini case, for example, we determined the net present value of the company's contract to make duffel canvas and compared it to selling an old factory that the company wouldn't use unless it got the contract. The contract's NPV was a challenge to compute, but the data was all there, and we only had to compute one NPV. That was an easy case because there was little to no uncertainty involved. Most investment decisions aren't like that. Chapter 10's introduction lays out a number of questions managers should answer, and the questions and answers aren't always financial. The financial piece comes in the second question. Do financial forecasts give due weight to possible favorable and unfavorable outcomes? What if sales don't meet expectations? Can we reduce costs and increase the project's NPV by doing the work in a different location? In Chapter 10, we start learning how to answer such questions. Some techniques are sensitivity analysis. Essentially, we compute NPV several times by changing some of the formula inputs or variables. Sales could be higher or lower. The mix of variable and fixed costs could change, and so forth. Scenario analysis takes this a step further by looking at combinations of related variables. So, if variable costs and revenue are linked, so for example inflation affects selling price and variable costs in the same way, we don't need to do a sensitivity analysis on these items separately. Instead, we consider them together. Still though, we're calculating NPV using different inputs based on alternative scenarios. Since we already know how to calculate NPV, I'm not going to ask us to do it again, so there are no assignments associated with this chapter. Chapter 11 provides an introduction to risk, return, and the opportunity cost of capital. It reinforces that investors want a return at least equal to the return they'd get investing in similar projects elsewhere. And we learn that market risks can be measured. But then we come to a conclusion that we can't look at a single stock in isolation. We have to measure its sensitivity to fluctuations in the overall stock market. And that leads us to Chapter 12 and the Capital Asset Pricing Model, CAPM or CAPM. We use the CAPM to determine what return investors expect if they invest with us. To calculate the expected return, we need to know, certain things. First, the risk-free rate of return. And that's typically what an investor could get by investing in U.S. Treasury bills. Treasury bills are considered the safest investment because there's almost no risk of default. We've got a pretty good track record. We haven't defaulted since George Washington became president back in 1789. That is our risk-free rate of return. We also need to know what the risk premium is. And since we're not asking investors to invest in treasuries, the risk they take is going to be different. So this risk premium has two components. First, market risk. So that's measuring overall market risk, often based on historical returns from the S&P 500 index. We subtract the risk-free rate from this So if the overall market return was 7% and the risk-free rate on Treasury bills was 1%, our market risk premium would be 6%. The next component is known as beta, or the risk premium that's unique to the company we're interested in. Chapter 12 explains how this is calculated. But it also tells us that we can work smarter because beta is readily available for publicly traded companies. So I'm not going to ask you to calculate it. I'd rather like you to get some practice looking it up in Yahoo Finance, and then with that information we'll go ahead and try calculating the expected return on a company's projects. Use the formula in section 12.3 and you'll be plugging in the variables that I just discussed. Expected return, that's what we're going to calculate, which equals the risk-free rate of return plus beta multiplied by the market rate of return minus the risk-free rate. Now, do take a look at the book before trying to calculate this, because the parentheses telling you the order of doing the math is somewhat important. It's laid out there. But anyhow, that's the formula, and so we'll calculate the expected rate of return using web exercise 1. So go to finance.yahoo.com, look up the company, and there are several of them listed in web exercise 1 at the end of chapter 12. Then look up the current Treasury bill rate, and the problem gives you guidance on where to look in Yahoo Finance for that. Assume a market risk premium of 7%, and then calculate the expected return for the companies listed. Then also do the same thing. Find the expected rate of return for the company you're following. The expected rate is appropriate for most projects a company would undertake. So now we know where the discount rate in an NPV calculation comes from, and we know how to calculate it. The text points out rightly that project risk may not always be the same as a company's overall risk. For average projects it is, but sometimes there are significant differences, and the textbook gave a good example of Walmart, a retailer, wanting to move into e-tail, electronic commerce, essentially to compete with Amazon. So a project like that, it would be more appropriate to use the beta for a company that's already in that marketplace that we're seeking to enter. In this case, Walmart should have used Amazon's beta rather than its own. The book also points out that we shouldn't use fudge factors. Use the CAPM to determine the expected rate of return on a project. No need for fudge factors. We accomplish the purpose that managers might use those for by doing the sensitivity and scenario analysis that's discussed in chapter 10. So that is a whirlwind tour through chapters 10 through 12, and I believe it got the meat of all of them. So in my next video, I'll take on the weighted average cost of capital, or WACC. That's covered in chapter 13. So I will talk to you soon, and I'll look for the web exercise 3 as an assignment in Sakai. Thank you and good evening.